All right, now let's get to our Squawk Newsmaker of the morning. Joining us now on set, Minneapolis Fed President Neel Kashkari. And Neel, given the events of the past week or so, and going back to October to Chairman Powell's comments, all of it in light of your comments that go back, I'm trying to think how far back it goes, where I think there was a time where your comments or your analysis was met here with some skepticism.
I can't imagine that, Joe.
It was. And I wouldn't go as far as to say eye rolls, but you have been more dovish than perhaps any of your colleagues at the Fed at this point.
I think, right? Jim Bullard and I are probably.
You and Bullard.
Yeah.
Just give me, because
you were before Bullard even, I think.
You might have been before Bullard. What is it 18 months? Is it a year? What is it for you?
I've been in the Fed now for 3 years. So for 3 years since I've been at the Fed, we have been surprised by the labor market. We keep thinking we're at maximum employment, and then wage growth is tepid, and the headline unemployment rate drops further. Inflation has been well under control, and 200,000 jobs a month, like clockwork, are being created by the U.S. economy. My basic message is if the U.S. economy is creating 200,000 jobs a month, month after month, we're not at maximum employment. And so that's the continued surprise, and that's been leading me to take my policy position.
So is it that we all bought into the baby boomer, that's why the people that are out of the workforce, everyone uses that and says that it's not that they're, that's what was it was at a 40-year low or something? What,
right,
60%?
just the aging workforce. But
that was the excuse, but there were a lot of 25 to 54-year-old people that were in there that you can't write off as baby boomers that weren't working, that weren't being counted. Is that where we got the 200,000 every month?
That's part of it. But basically, the 3.7%, that's the headline unemployment rate. That's usually been a pretty good proxy for slack in the labor market. But the Great Recession was so devastating, it just pushed a lot of people out of the job market, and they are only slowly come back in. And so we don't know. If wage growth actually picks up, we don't know how many more are going to come back in, how many more retirees will say, you know what, I'm going to work for a few more years. We just don't know. So my view is, until we see wage growth really pick up, until we see inflation pick up or inflation expectations pick up, let's let the job market continue to
That's such an appealing thing to me now. I never was before. I figure, we got to get ready for the next time and build up some dry powder so we can cut rates and all that. But if all you have is a strong economy, and for some reason there's not the fear or the prospect of higher inflation, I don't see why you just arbitrarily have to raise rates just to do it if you're not seeing any nascent inflation.
Exactly. So if wage growth were to pick up to levels that would imply high future inflation, or inflation picked up, or inflation expectations, then absolutely.
So how many of the 7 increases would you not have done?
I think that we should be normalizing rates.
We don't know what normal is now. Jay Powell changes his mind on normal depending on the...
There's a lot of uncertainty around where the neutral rate is. I think we're close to neutral. Maybe not quite there yet, but close. That's what I said in my op-ed.
That's what he said. After he said we're far away from neutral.
There are huge ranges of uncertainty around these things. But that's why I look at the data, look at inflation expectations, look at wage growth, and look at job growth. All of that says there's still slack.
Hey, Neel, the problem with that theory, and the critics who have jumped on it have said, look, in the past, every time the Fed has gone to raise rates or has tried to stop inflation, they've waited too long. If you wait till you see the whites of inflation's eyes, it's too late in the game. The Fed misses it. What do you say back to those critics?
I say that
here's how we do it differently this time.
Inflation expectations are so anchored because of the political independence of the Fed, because the Fed has done a good job over the last 20 or 30 years. That, to me, is something that's enabling this economy to continue to strengthen, enabling the job market to continue to strengthen without inflation taking off. And so, let's let it continue.
It is historically what has caused us the most problems: being behind the curve on inflation, or
raising rates
strangling
too fast
off
and cutting the economic,
going too far in strangling the economy.
Well, I mean,
what's more likely? What do you worry about more?
I'm more worried about that we raise rates prematurely when the job market still has slack and wage growth hasn't picked up yet.
And that's certainly been the historical precedent recently.
We know, I believe certainly that if the Fed were to raise rates dramatically, we could cause a recession. Nobody wants to do that.
Have you seen anything yet? I mean, do the unemployment claims, did that catch your attention lately, or housing?
Housing is catching my attention.
It is.
Autos is catching my attention. We know that interest rates affect these sectors of the economy. So it is already affecting the economy.
So when you hear the president say that the Fed and the move on rates is a bigger problem than China, by the way, does China enter your calculation?
China's the big uncertainty because it's very hard for us to game out what does a trade war look like, how does it end up manifesting itself either in the stock market or in investment with businesses. That's the thing that's very hard for us to analyze.
You guys talk about that?
We do. We talk about it a lot. What we're hearing from our contacts, in my district, we're seeing a lot of ag sectors under a lot of pressure from low commodity prices. The tariffs are making it worse for many of the farmers. So that's something that I hear real time in my district.
Just in terms of the viewpoints we get on the economy, depending on who you talk to, depending on where the pain points are, you'll hear people say, look, there's a lot of concern when you look at housing, when you look at agriculture, when you look at car sales, or you'll hear the flip of it, which is this is an economy that is in rip-roaring condition. Things are going great. Is there a way to kind of take those two views and say they're both right?
Well, I think overall the economy is doing well. 3% real GDP growth on an annual basis, that's pretty healthy given our demographics, given our population growth levels. So that's overall healthy, but there are sectors of weakness, and they're the sectors that you would expect in a rising rate environment to be more.
You're mad at Trump, and he's criticized Powell. You don't like that, but you guys are singing from the same hymnal. He's been saying this. You're saying the same stuff. Again, it's style, not substance with him that you have a problem with. He was saying exactly what you were saying, and you don't want him to say that to Powell. You were saying the same thing that he was saying about raising rates.
So hold on, I haven't said anything.
What do you think?
Commented.
Do you think he ought to be trashing Powell in public like that?
I think that if the American people want low interest rates, you think about this for a second. In 1980, U.S. debt to GDP was 26%, and the 10-year Treasury was at 12%.
Yeah.
Today, we have 3 times as much debt, and the 10 years at 3%. What's the difference? The difference is Fed independence. So if the American people want low interest rates, the way you get there is by doubling down on Fed independence.
Although people will say, look, the reason we're there is because of interest rates in Europe. If you look at the GDP, if you look at the German bonds, if you look at what's been happening with the JGBs, I mean.
But over the last 30 or 40 years, central bank independence has been one of the hallmarks in advanced economies around the world. And so we're all benefiting from that, whether it's the ECB's independence, et cetera.
It definitely builds confidence from business leaders. But if you looked at the real reason why we're looking at rates being so low with such a great economy, you have to say it's coming from the comparison. Like, where's your money going to go?
No, I don't agree. I think that real rates around the world have gradually declined for a lot of reasons. They've declined for technological reasons, demographic reasons, productivity, but also I would say the biggest factor all around the world in advanced economies, it is that politicians have said we need to keep monetary policy separate.
So should so he's in a different position. He's the president of the United States, but different people on the Fed go out, and I see it all the time. There seems to be if someone has a divergent opinion, it's welcomed at the Fed for them to go out and share it, like you or Bullard. Jim Cramer has jawboned, or at least made comments about Fed moves that he thought might not be proper. So, but when a president does it, does that suddenly threaten the independence of the Fed? No one thinks he's going to come in and actually, tell them what to do specifically, right? Is job owning okay?
Politicians all the time on both sides of the aisle.
Bully pulpiting, is that okay?
Comments about what they would like the Fed to do.
So you don't have a big problem with it then?
I don't have a big problem with that because I know Jay Powell,
I thought you did have said in the notes you have a problem.
Jay Powell and all of our colleagues are focused on the data. And so politicians on both sides of the aisle make comments.
People say he wasn't quite as focused on the data back in October.
Jerry's very focused. I know.
So you're going to do how many next year if you had to guess?
I never make predictions.
That'll come. If you say it right now, if you tell us how many, I will watch it come up right here on the Reuters
That's why
wire.
That's why I never say it.
Smart man.
Do you think between 0 and 10 is a good? Can I get you to say that?
It could be between 0 and a higher number than 0.
Okay, so it could be 0 and it could be 1, 2, 3, something like that. But I think you would like knowing you'd maybe do December and stop, right?
I wrote an op-ed 6 weeks ago saying we should pause right now. Just
really?
I want to wait.
You still feel that way?
I do.
Okay, well then you just said it.
Can I ask you a separate question?
Sure. That's 0.
Jay Powell on Wednesday talked about his anxiety around corporate debt leverage levels. You've talked about leverage before. You've talked about breaking up the banks. Do you have a new view on sort of the grand risk behind all of this?
Well,
and whether by keeping rates as low as they are, you're only increasing that risk?
Well, here's the thing. Monetary policy is such a poor tool to use for these kind of financial stability risks. And I'll give you an example. 1996, Alan Greenspan said irrational exuberance. If the Fed had raised rates in 96 to try to stop the stock market from going up further, it would have been much costlier to the economy than the actual recession that happened when the tech bubble burst in 2001. So the cost of false positives is very high.
That's like a Chuck Prince, while the music's playing, you got to dance.
No, that's not. It's making sure the banks have enough capital so that if they make a mistake, they can withstand it. It's using the right tool for the right job. Monetary policy is not the right tool to deal with that.
Neil, Jim Cramer said the same thing a couple of nights ago on Mad Money. He said that what the Fed should be doing is regulating some of these areas and using that tool in the toolbox. If you look at some of the non-bank lenders in other areas, is that something that's under discussion at the Fed?
Well, the challenge is we have limited sets of regulatory powers. And so the Fed has a lot of regulatory powers over classic banks and big banks. Over the non-banks, it's a lot murkier on what tools we have or the SEC has, et cetera. And so that's something that we do analyze, we pay a lot of attention to, but we do admittedly have limited tools on what we can do about it.
Does that concern you?
It does, absolutely.
Do you think either the rate increases that we've seen or the October Judy Woodruff interview had anything to do with the sell-off in things like Bitcoin or oil or the stock market? Or, I mean, do you think there's sort of, when you stay at zero for so long, are asset bubbles forming? And when it starts going the other way, is this to be expected that you see these things come back to earth?
I mean,
technology, whatever?
I think when you see liquidity coming out of the market, you are going to see, it's to be expected that you would see some market response. Now, the thing is that's unclear is thinking about quantitative easing and shrinking our balance sheet. How much of that gets priced in immediately once we lay out our roadmap on the path of the balance sheet versus how much actually how many of the effects come over time? That's still as yet unclear. I think Janet Yellen and Jay Powell have done a great job saying this is exactly how the balance sheet's going to wind down to minimize uncertainty. But has all of that already been priced in? I'm not sure.
Do you think that for years, when we were at zero, that sort of boost really did mask weakness in the overall economy? And now, and let's say it was 50% zero, 50% real economy. If you take away that 50% now, all we're stuck with is a real economy. Are we dealing with that now, that we have to sort of take off the training wheels? I mean, is that part of the problem now?
Well, where does long-term economic growth does not come from central banks. It comes from population growth and productivity growth. And so that's where the fact of the matter is our demographics are what they are. Our workforce isn't growing very quickly just because of demographics and slowing immigration. We can model that out. And then there's the productivity piece. That either of those are up to the Fed.
Are you pessimistic about both of those components, and that's why you think we should stay low? It's going to be...
Well, no, I'm saying we should stay low. This is a cyclical versus a longer-term secular story. Cyclically, I'm focused on how much slack is in the labor market. I think there's still slack. Let's bring as many workers.
Secular, can we grow at 3%?
Where are we in the cycle then?
Well, we don't know. I mean, we don't know how long these cycles can go on.
Do you think productivity can make up for the population not growing? You don't. So you think that the run rate is 2%, or what do you think?
Probably. I don't see any evidence that longer term, unless we do something about our population growth rate, unless we do something about immigration, I don't see any evidence of why the U.S. economy will grow higher than 2% over the long term.
Well, it grew 2% when we had a lot more regulation and we didn't have the corporate tax cut. Now we've had the corporate tax cut and the deregulation, and you still think the best we get is 2%. So was that being aided by 0% rates?
It was being aided by 0%.
That's why it happened.
Correct.
So that would be a win. To be able to do 2% without 0% interest rates would be a win for deregulation and tax reform.
I think the tax reform is still too early to know. Is it actually leading to a supply side, longer term productivity enhancing investments? I think it's still early to know that. We know there's a Keynesian stimulative effect of just putting more dollars into the economy, more fiscal spending. But is it actually going to lead to a higher long-term growth rate? I just think it's unclear so far.
Can we go back to the balance sheet for a moment?
Sure.
There was the story earlier this week that said the Treasury Secretary, Stephen Mnuchin, had been feeling people out about the idea of tightening monetary supply by tightening the balance sheet, getting rid of liquidating the balance sheet a little faster rather than raising rates. What do you think about that entire argument? Because it's one that's been put out there by other people too.
Yeah, I think quantitative easing and expanding the balance sheet was a big uncertain move. I'm glad the Fed did it. I think it was the right thing to do, but a lot of uncertainty. So my view is we want to minimize the uncertainty on the way down. And that's exactly what Janet Yellen and Jay Powell have done by laying out the plan so carefully. So I would be very loath to change those plans that we've now communicated to the markets. We have a lot more confidence and experience in using the federal funds rate to manage the economic cycle than to try to use the balance sheet to do so. So that's not something that I would be in favor of.
Just from a theoretical perspective, what does happen when you tighten up the balance sheet, when you roll that down a little faster? Only because we know that raising rates hits Main Street pretty hard. If you're bringing up mortgage rates, if you're bringing up auto loans, those are the type of things that are felt in other places. Who feels it when you tighten the balance sheet?
I think the exact same people. Because ultimately, we move the federal funds rate up and down. And the reason we do that is because it affects long rates, which then affects mortgages and affects auto loans. If we just manipulated the balance sheet and manipulated long rates directly, it would also affect auto loans. It would also affect mortgage rates directly.
Two related things.
It's just a less clear way, a less transparent way of doing it.
Two related things. Is there anything to the notion that the Fed missed opportunities at some point in the past when it would have been easier to extricate itself? And I have people tell me that all the time. Yeah, we shouldn't be raising now, but we should have raised a couple of years ago. Is there anything to that at all?
No, it's just people who believe that we don't like low rates and we don't like.
Is there anything to the notion that the Roach Motel notion that the reason we're having problems now and suddenly we can strangle an economy at 2.5% is because somehow we stayed too long and we didn't let prices go where they should have gone. So we're not having trouble. We checked into the QE Roach Motel and now we can't get out.
No,
there's nothing to that either.
It's the earlier conversation we had. Why are interest rates around the world in advanced economies low? It's not because of central banks. It's because of these broader factors.
Are you sure?
Of productivity growth, demographic factors.
Nothing to do with staying too long.
All central banks are doing are managing interest rates around this neutral concept, but the neutral rate has been dropping for 30 years. And that's not because of short-term movements in the federal funds rate.
You're definitive about that.
I'm definitive about it.
I'm upset though that he's at 2%.
I know.
I think that's going to create a real problem if we.
No, it's.
Wait, what do you mean?
That your GDP expectation is long-term, 2%.
Yeah. I mean, I'm not disagreeing
but with
you,
inflation at 0.2%.
No, but we've built our entire tax program and everything else around a number that's significantly higher than that. So if you don't hit those numbers, you have a much larger problem.
We need our workforce to grow. We need population growth, and we got to figure out how to get it.
That's an argument for immigration.
You're worried
reform.
about the trillion again, but you didn't worry about the 10 trillion from the last guy.
You know, I think there were totally two different circumstances.
One
was in the middle of a financial crisis, and one was,
he might agree with you on that, but I don't think so.
You agree with me there? He's saying, why should I be upset that we're taking on $1 trillion of debt today when
in the middle of the financial crisis?
In the middle of the financial crisis.
In the middle of the financial crisis, they rammed through Obamacare without a single Republican vote. You weren't even doing financial crisis management unless talking about cash for clunkers again.
Let's go back to immigration reform. This is an argument for immigration reform if you want to build productivity numbers.
If you want to grow the economy in the long term, look at Japan. So Japan has worse demographics than we do. They're trying to subsidize fertility to try to encourage their Japanese families to have more babies. You know what? It takes 20 years to grow a new worker. It's a very long-term solution, if it's even possible. The U.S. has a huge advantage because people want to come here. And so I actually think an immigration program that feeds our economy, that meets the needs of our economy, is the single best thing we could do to boost our growth rate over the long term.
I got a question on a totally different topic. Okay. Last night I was talking to Jay Clayton. I did a talk with him, and we were talking actually about Christine Lagarde, who made some comments recently about the idea that central banks should consider issuing digital currency. You know, we had debates over the years about the future of Bitcoin. Yeah. I thought actually this was the first time I'd ever heard someone of her stature say, actually, what the Fed and others around the world should be doing is actually issuing their own cryptocurrencies. What do you think of that?
I don't even know what that means. I don't even know what a Fed virtual currency means. I mean, how is that different than the $10 in your PayPal account? Is the $10 in your PayPal account, isn't that a Fed cryptocurrency that's already in your PayPal account or in your online checking account? I just don't even know. When people make these comments, I don't even know what it means.
That's an interesting perspective.
Or she's saying we should have this ledger, this open ledger system for the Federal Reserve. But what is the actual problem we're trying to solve, and how does a Fed virtual currency solve it. Nobody's explained that to me.
Do you guys have conversations, by the way, about cryptocurrency and Bitcoin and things like that?
We do. We pay attention to it more as I get asked about it a lot. So I go out and I give town halls in my district, and especially young people want to talk about
In the actual Fed per se, you're not. I don't think.
Well, no, that's what I'm saying. Do you and Jay Powell and the rest of the group, when Jim Bullard's around, do you guys say, there's this thing going on, what do we think of this? Do we ever think
over coffee? It's not been a topic at the FOMC that I've been part of.
You're sad about
Interesting.
that. Yeah.
No, but it's fascinating to know that actually they're not having that conversation.
You talked
in a way that
you loved it at 10. You're not talking nearly as much about it as you used to.
We're talking about Bitcoin like crazy.
He's been at 2 conferences this week.
I know
for it.
conferences, but lately, as it's come from 8,000 down to 4,
I'm fascinated by the volatility of it all.
Okay.
Fascinated by the volatility. Nice way to put it.
All right. Thank you.
Thank you very much.